Happy morning, guys. Moving on to the next chapter, that is chapter number 7, cost of capital. So now we have finished this cash flow statements. So I went a little bit fast in this cash flow statements. It was like once after recording the videos I watched, so I itself was feeling like it was fast. But I don't know about the how the students are getting it. Like see, some people are giving reviews like you are going too slow. I thought like already it is being taken fast, but then people are telling it's slow, so I can improve my speed. So like if for some people no, for some people if they can catch the point the first time itself, but for some people we have to explain it twice or thrice. At least if it is offline classes like direct classes, they can come and ask doubts, so we can just take off fast, and if they have doubts they can come and clear it later. But now due to this online classes, we should definitely explain things so that students can easily understand it. Without even understanding, watching all the videos for 2 or 3 times, it's no use of that. So the key point is to make you understand the concepts. Then if you are solving the answers, if you are seeing the questions and answers, you itself will understand, okay, this is the reason for this step. So understanding the concept is the basic prerequisite for numerical papers. So okay, now we'll move on to this chapter number 7, that is cost of capital. So still 4 more chapters are left. In that, cost of capital is one chapter. Chapter number 7 is cost of capital. So what is this cost of capital? Cost of capital is nothing but it is a rate at which you are evaluating the desirability of the investment project. Suppose, see, what is this capital? First, we'll understand what is capital. Capital is nothing but long-term funds which are procured and utilized for the purpose of running the business. So, capital is nothing but a long-term fund which has been procured and utilized for the source of finance. So, what are the different long-term funds? Equity share capital, preference share capital, debentures. That is long-term debts. So, all these are three different capital. So for procuring and utilizing these capital, that is equity, preference share capital and debts, for procuring, that is for getting those funds and utilizing those funds in your business, you have to pay a certain amount of cost. But that cost differs for each of the capital. That is, for equity share capital, the cost is paid out as dividend. For preference share capital, the cost for the procurement and utilization of resources, that is preference share capital, is paid as preference dividend. Whereas for debentures, the cost for procuring and utilizing those debentures is paid out as interest. So all these interest on debentures, preference dividend, equity dividend, all these are the different cost which has been incurred by a company, which has been incurred by a firm in order to procure and utilize funds. That is, in order to procure and utilize some finances, these costs are incurred. So summation of all these costs, that is all the costs incurred for procuring and utilization of financial resources, that is all the sources of finance, are called as cost of capital. And there is a certain percentage of cost of capital which we should calculate as a whole. Simple. For debentures, you may procure it by giving 10% debentures, 12% debentures. For debentures, the interest paid will be different. For preference dividend, the dividend given will be different. Whereas for equity dividend, the dividend is paid out of the remaining profits of the company. So for all three, the costs are different. And adding all the capital and finding the weighted average, that is finding the weighted average of all the capital and calculating the cost of capital, is the function that has been done in this particular chapter. So for interest, that is for debentures, you will pay interest. For preference share capital, you will pay preference dividend. For equity share capital, you will pay equity dividend. So all these costs, different costs put together, is the total cost incurred for utilization of the capital. So what is the total capital? When you divide total cost by total capital, you will get the total, that is cost of capital, as a percentage. So this is the cost of capital. So this is the basic idea over this cost of capital. You will be incurring dividend, preference dividend for preference share capital. You will be expending interest for debentures, and you will be expending dividend for equity shareholders, equity share capital. So all this put together is the cost of capital. So now we'll go, first we will take down some notes, that is different formulas, so that Once we are getting into the problems, you won't have any doubts regarding the formulas. So first, take the notes. Formulas, take the notes. Chapter number 7, to the heading chapter number 7, cost of capital. Chapter number 7, cost of capital, underline it. See, what are the different cost of capital? Debt, preference share capital, equity share capital. All these are three are different cost of capital that we have found in the that we have studied in this theory. So okay, below that cost of capital record debt. Debt within bracket KD. KD is nothing but cost of capital. When it is KD, that is cost of debentures. When it is KE, that is cost of equity. And when it is KP, then cost of preference share capital. So now record debt within bracket KD. Within bracket KD. KD is nothing but cost of debt. So now divide the debt into, now draw a flow chart. Draw a flow chart. Left hand side arrow mark and right hand side arrow mark. On the left hand side record irredeemable debt. Irredeemable debt within bracket IR. Irredeemable debt within bracket IR. On the right hand side record redeemable debt. Redeemable debt within bracket R. So what is this irredeemable debt? Irredeemable debt is nothing but which is not redeemable at lifetime. Simple. Redeemable means you can redeem it whenever you want. Irredeemable means you can't redeem it. That's all. That is the difference between redeemable and irredeemable. Just understand it. Redeemable means you can redeem it. You can take your payment out. That is, suppose you purchase 10,000 debentures of a particular company. If it is a redeemable debt, then the 10,000 debentures you can return the debentures shares, debenture certificates. Then you can get the cash back. That is called redeemable debt. Irredeemable debt is the debentures which you purchased by giving cash and purchasing the debenture certificates. Those debenture certificates is not, you can't give it back and take your money out. So that is called irredeemable debt. That's all. Simple, understand it. Redeemable debt means you can redeem it. Irredeemable debt means you can't redeem it. There are two types of cost of capital. Cost of debt. One is irredeemable debt, one is redeemable debt. For irredeemable debt, the formula is cost of debt, that is KD is equal to interest into 1 minus tax rate divided by net proceeds into 100. Write it down. Below that irredeemable debt record KD is equal to, KD is nothing but cost of debt is equal to interest within bracket 1 minus tax rate, interest into within bracket 1 minus tax rate divided by NP, that is net proceeds into 100. So what is this irredeemable debt? You can't redeem it for lifetime. And what is the cost you are paying for those debt? Suppose we as a company, you and me, we both started a company. We are issuing debenture holders, debentures, and some people, nearly some 100 people are purchasing that debentures. Okay, for those 100 people, what you will pay? You will pay interest as cost. So they are purchasing 10,000. Suppose 100 people each are purchasing 10 debentures. Total 1,000 debentures. For everyone, for 10 debentures, you will be paying interest. So what is the cost you are paying for those debentures? Interest. So interest into 1 minus tax rate. Only for the debentures, this tax rate will come. In 1 minus tax rate will come. Why? Because debentures interest are paid before payment of tax. Do you remember we studied that marginal cost statement? EBIT minus interest, then only EBT. So after paying interest only EBT, then only you will deduct tax from the EBT. So normally the steps are EBIT minus interest, then EBT, then only you will deduct tax. So interest form part of tax expenses. So interest into 1 minus only for the interest. But whereas for dividend, how you will pay? In case of dividend, EBIT minus interest, you will pay EBT. Then minus tax, you will get what is PAT. Out of that PAT only you will pay dividend. So there is no tax component in the dividend PAT. Whereas in EBIT there is some tax component. So you are deducting 1 minus tax rate. Simple. So interest into 1 minus tax rate divided by net proceeds. What is this net proceeds? Understand it. Net proceeds is nothing but how much money you are getting in hand. Suppose we both as a company, we started a company, we are issuing 1,000 debentures. That is 100 members are purchasing 10 debentures of 100 each. Suppose for issuing that 1000 debentures of 100 each, we are getting 1 lakh rupees total amount. Out of that, there is some cost we should incur for those debenture certificates to print and give it to them. If they are coming and purchasing debentures, we should not send them without even any good gesture, that is like providing them with some offers, some gifts. So this is called floating cost, the cost incurred for issuing the debentures. So suppose for the 1000 debentures of 100 each, that is 1 lakh rupees, you are expending 5% as floating cost. Then what is the 100 rupees into 5%? That is 5 rupees. So 1000 into 5 rupees, that is 5000 rupees is the floating cost. So 1 lakh rupees debentures you have issued, 5000 rupees is the floating cost. So how much is the amount you are getting in hand? 95,000. So that is called net profits. Net amount which you are taking back in hand, that is after issuing debentures, after giving certificates, after finishing all the process, how much is the amount left in the hand? 95,000. So that is called net profits. Net profits is nothing but issuing price minus floating cost. Then you will get net profits. So interest into 1 minus, for irredeemable debt, it is interest into 1 minus tax rate divided by net profits into 100. Now moving on to redeemable debt on the right hand side record. Below that redeemable debt record, KD is equal to interest into 1 minus tax rate, interest into 1 minus tax rate plus, open a big bracket, redeemable value RV minus NP divided by N, RV minus NP divided by N. In respect of RV, put an arrow mark and record redeemable value. Redeemable value. In respect of NP, record net profits. In respect of N, record number of years. So within bracket RV minus NP divided by N, RV minus NP divided by N, close the bracket, whole divided by NP plus, within bracket NP plus RV divided by 2. Within bracket NP plus RV divided by 2 into 100. Into 100. So what they have explained here. See, redeemable debt means what? Redeemable debt is nothing but, suppose you are issuing 1000 debentures of 100 each for 5 years. Then after 5 years, the debenture holder can redeem it. That is, he can give the debenture certificate, he can purchase, he can take back his amount. So today you are issuing 1000 debentures of 100 each. You are telling that after 5 years you can redeem it at 105 rupees. Okay. Today you are issuing at 100 rupees of 1000 debentures, where you are telling you can redeem it at 105 rupees after 5 years. So you are receiving interest, that is, suppose it is 10% debentures. You are receiving on 1 lakh rupees 10%, that is 10,000 rupees into 1 minus tax rate, because interest form part of tax. So because EBIT, after that only you are deducting interest, then EBT. So tax form part of interest. So you are taking out the tax rate. So 1 minus tax rate into interest plus redemption value. For this example which I gave, what is the redemption value? You are taking back after 5 years at 105 rupees. So 1000 into 105, that is 1,05,000. Whereas net profits, how much? After floating cost of 5,000, that is, you are incurring for floating cost of 5,000 for 1 lakh rupees. So 95,000. So 1,05,000 minus 95,000 divided by, for how many years after that you can redeem the debts? 5 years. So divided by 5. That's all. Redeemable value. That is redemption value. After 5 years, at what value you can redeem it? Redemption value minus. What is the net profits? Net profits is nothing but whatever the issue price minus floating cost. That is net profits divided by N. N is number of years. Whole divided by same net profits plus redemption value divided by 2 into 100. That is redeemable debt. Don't memorize the formulas as of now. Once you do the problems, you itself will understand why they are giving this redemption value, because it is redeemable debt. That's all. So they are giving this redemption value. Once you do the sum, you will understand. So this is the debt, that is KD, cost of debt. So below that, leave one line gap, record. Next, what is the next capital? One is debentures. Next one is preference shares. Preference shares within bracket KP. KP means cost of preference shares. Now below that, draw a flow chart. Draw a flow chart. Left hand side, irredeemable preference shares. Right hand side, redeemable preference shares. Same like equity, same like debentures, but one thing which you should not consider here is 1 minus tax rate. That's all. That's all. That 1 minus tax rate won't come. Remaining everything there you are giving interest, here you are giving preference dividend. That's all. So on the left hand side, irredeemable preference shares, below that record KP is equal to cost of preference is equal to what is the cost you are paying for the preference share capital? Preference dividend. Preference dividend is paid out of profit after tax. So there is no tax element. 1 second. So what is that? Preference dividend is paid out of profit after tax. That is, after deducting the tax amount from the EBT, you are getting PAT. From that only you are paying preference dividend. So there is no tax element in this preference dividend. So simple. Whatever the preference dividend you are paying divided by what is net profits, how much of, suppose for example you are issuing preference share capital and there is floating cost of 1%. Suppose you are issuing preference share capital of 100 shares of 100 each, that is 10,000 rupees, and there is 1% floating cost. So out of 100 rupees, what is 1%? 1 rupee. So 1 rupee you should minus. So total of 10,000 rupees minus 100 rupees, you will get 9,900 as net profits. So it should be taken to net profit. Simple. Whatever floating cost you are getting, you have to deduct it from the issue price so that you will get net profits. So preference dividend divided by net profits into 100. That is the cost of preference share capital. In case of irredeemable, in case of redeemable, again you should do the same thing. What is the redemption value minus what is the net profits divided by n? Whole divided by redemption value plus net profits divided by 2. Here it should be minus in the numerator, and in denominator it should be plus. So below that redeemable preference shares, record KP, cost of equity. KP is equal to preference dividend PD plus within bracket RV minus NP divided by N. RV means redemption value minus net profits divided by number of years. RV minus NP divided by N, close the bracket, whole divided by, below that denominator open a bracket, RV, redemption value plus net profits divided by 2. Redemption value plus net profits divided by 2 into 100. That is the redeemable preference shares. If they are giving redeemable preference shares, then you should calculate the cost of preference shares using redeemable formula. Whereas if they are giving irredeemable preference shares, you should find it using this irredeemable preference shares formula. Ultimately, what they are asking us to pay cost of capital. That's all. Cost of preference shares, cost of debt, cost of equity. They will ask us to find in the problems. So next is important thing, that is equity. Below that record, leave one line gap and record equity within bracket KE. KE means cost of equity. Now below that record first arrow mark. There are few different formulas for this equity, because equity holders are receiving dividend. Using the dividend also you can find what is cost of equity, and you can also use other formulas like dividend and then dividend growth model. Then you can use earnings without growth and earnings with growth model. Then you can also use CAPM, that is capital appreciation pricing model, capital asset pricing model. You can use that also and find equity, cost of equity. So we'll see one by one. What is this equity? So below that first arrow mark, dividend without growth. So what is first growth? We'll see. Growth is nothing but a certain portion of growth which will be occurring in a company or in a firm every year. That is called growth element. Growth will be always given in percentage. You can also calculate what is growth. There is a formula for growth. We'll see it later. It will be coming in the later part of the formula. So without growth, first is dividend without growth. First I mark dividend within bracket without growth. Below that record KE is equal to dividend divided by net profits into 100. That's all. Dividend divided by net profit. What is the equity dividend divided by what is the net profits? That is after floating cost, what is the net profits into 100. Here for equity, there may be net floating cost. Also, there may be some other commission, underwriting commission, all those things. So, what is the net profits? Dividend divided by net profits into 100. That is using dividend without growth. If they have given dividend, if they have given a particular problem, that there is an issue of equity shares where equity shares are paid out as dividend. Cost of equity shares are paid as dividend. There is no growth in the equity. So then it is called dividend without growth. You should use this dividend without growth formula. Whereas if they are given any growth, you should use dividend plus growth. So now it is fine. Dividend divided by net profits into 100. That is the cost of equity. Now below that first arrow mark, Second arrow mark. Dividend with growth. Dividend with growth. Dividend within bracket with growth. With growth is nothing but dividend divided by net profit into net profits. Dividend divided by net profits into 100 plus growth. That's all. Growth is percentage. So here we will get 1%. If suppose for 10,000 equity shares of 10 each for 1 lakh rupees, you are getting dividend of 10%. So what is 10,000 is the dividend. So 10,000 divided by what is the net profits? 1 lakh. 10,000 divided by net profits into 100, you will get 10%. Growth is 4%. Then 10 plus 4, that is 14% is the cost of equity. That's all. Dividend with growth is KE is equal to, that is cost of equity is equal to KE is equal to same dividend divided by net profits into 100 within bracket dividend divided by net profits into 100 plus G. G is nothing but growth. So below that third arrow mark, earnings without growth. Earnings without growth. See, nothing is paid out as dividend. Suppose in a particular company like Google and all, they won't pay any dividend because Google itself will ask whether you people are receiving any good returns compared to Google if you invest this amount outside. So there is no dividend paid out by Google. So KE is equal to earnings without growth. Earnings without growth. Below that KE, cost of equity, is equal to EPS. EPS means earnings per share. EPS divided by PO. PO can be recorded as MP also. PO is nothing but market price at the current market price or market price at the beginning of the year. So current market price. PO means current market price per share. When you are calculating using EPS, you should calculate what is the market value per share at the current market price per share. You can even calculate as EPS divided by MV into 100 or EPS divided by PO into 100. Both are correct. So cost of equity EPS divided by PO into 100. That is without growth. With growth means within bracket EPS divided by PO into 100 into plus G. That is growth. So below that fourth arrow mark, earnings with growth. Record earnings with growth. So KE, don't write this plus G here. KE is equal to EPS divided by PO into 100. PO means market price, current market price. So EPS divided by PO into 100. KE is equal to EPS divided by PO into 100 plus G. Within bracket EPS divided by PO into 100 plus G. So what is G? Now record. What is this G? Below that record G is equal to growth. Capital G is equal to growth is equal to B into R. B into R. This B is nothing but retention ratio. Now understand properly. Retention ratio is nothing but 1 minus dividend ratio. Dividend payout ratio. So suppose a company is having dividend payout of 60%. Okay. Company out of the total profits made to the equity shareholders, that is PAT, profit after tax available to equity shareholders, out of that 60% will be paid out as dividend. Remaining 40% will be kept in the retained earning. So that remaining 40% is called retention ratio. That's all. 1 minus dividend payout ratio is nothing but retention ratio. Understand it. B means 1 minus dividend payout ratio. That is called retention ratio. How much has paid out as dividend and remaining how much is there? That is called retention ratio. Into R. R is nothing but return on investment. Suppose if you are reinvesting that amount, that is retention ratio, how much return you will get from that retention ratio? That is in question itself they'll give. I think so in second problem it is there for this G. So retention R is nothing but return on investment. Return on investment. So BR, G is equal to B into R, that is retention ratio into return on investment. Return on investment. So that is called growth. Now below that record, below that fifth arrow mark, suppose you are receiving both dividend and capital appreciation. Okay, you are receiving both dividend and capital appreciation. There is no growth, but they have given capital appreciation. What is meant by this capital appreciation is, suppose at the beginning of the year your equity share value is 10,000. At the end of the year, if your equity share value is 12,000, then 12,000 minus 10,000, that is 2,000 is the capital appreciation. If they are giving at the beginning of the year 10,000, at the end of the year 12,000, apart from that dividend of 10%, that is 10,000 into 10,000, 1,000 rupees. Then total of 1,000 plus 2,000 capital appreciation. Total return for this equity is 3,000 rupees divided by what is at the beginning of the year 10,000 rupees value into 100. That is the dividend plus capital appreciation formula. Fifth arrow mark, dividend plus capital appreciation is equal to dividend plus capital appreciation. Below that record, KE is equal to D plus within bracket P1 minus P0. P1 is at the end of the year, P0 is at the beginning of the year. So D plus within bracket, D means dividend, plus within bracket P1 minus P0, close the bracket, whole divided by P0 into 100. Whole divided by P0 into 100. P1 is nothing but price at the end of the year. P0 is nothing but price at the beginning of the year. P1 is price at the end of the year. P0 is price at the beginning of the year. Below that record, P1 is the price at the end of the year. P0 is price at the beginning of the year. So this is called dividend plus capital appreciation model of calculating cost of equity. So with that, we have seen 5 formulas for equity. Now see the last formula for finding equity. That is CAPM. This CAPM will be, it will be like you will be having nearly 20 to 30 sums in final using this CAPM. Capital asset pricing model, CAPM, capital asset pricing model. So what is this capital asset pricing model is, first sixth arrow mark record, capital asset pricing model. Below that, KE is equal to RF plus RF, that is risk-free rate of return, plus beta into beta in within bracket RM minus RF, RM minus RF. RF plus beta within bracket RM minus RF, close the bracket. So what is this? Cost of equity is equal to risk-free rate of return. What is this RF? Risk-free rate of return. Risk-free rate of return is nothing but return which will be received by the government bonds. That is called risk-free rate of return. They itself will mention what is RF in the question. That is risk-free rate of return in a particular government bond is called RF, plus beta of the security is nothing but how much is the beta is nothing but the risk involved for purchasing this particular share. So beta of the security within bracket RM minus RF. RM is nothing but market, that is return from the market minus return from risk of market minus risk-free rate of return. RM means risk from the market. RF means risk-free rate of return. To deduct both, you will get what is the risk premium you have taken. Okay, because of purchasing this share, what is this risk premium you have taken? That can be calculated by RM minus RF into beta. If you do, you will get what is the risk taken in addition to the risk-free rate of return. If you add both, you will get what is cost of equity. Very easy concept. Very easy concept. RF they itself will give directly. Beta is nothing but it is a risk taken, risk involved for purchasing the share. So RM minus RF is nothing but risk from the market minus risk-free rate of return. That is the risk premium. This RM minus RF is nothing but RM minus RF is RS. That is risk from the risk premium from the security. Into beta, you will get what is the extra risk taken from the risk-free rate of return. If you add both, you will get cost of equity. Cost of equity. So with this you have completed what is equity. So we have found 3 things, that is cost of debt, cost of preference share capital, cost of equity share capital. Now below that, last formula record, this is not reserve, this is cost of capital, overall cost of capital. Below that record, overall cost of capital. Overall cost of capital will be taken as KO. KO. So below that record, KO is equal to within bracket KE into WE, which means cost of equity into weight of equity. Within bracket KE into WE plus within bracket KD into WD. Close the bracket. KE means cost of equity. WE means weight of equity. So what is the cost of equity and what is the weight of equity of your overall capital? Suppose overall capital is 10 lakhs and equity is 5 lakhs. Then weight of equity is 50%. So 0.5. So cost of equity into weight of equity plus again cost of debt. What is the cost of debentures into what is the weight of debentures? Suppose debentures is 3 lakh. So 3 lakh out of 10 lakh is 0.3. So weight of debt is 0.3. If you multiply like this, you will get what is overall cost of capital. For 1 rupee of capital, how much you are expending as cost. That is called overall cost of capital. So with this, we have finished all the theory formulas. Now moving on to problems one by one. Very easy problem. This chapter is seriously, this chapter is very easy if you understand it properly once. All you need is full focus. Now we'll go up to problems. We'll go to problems. Record problem. First take down page number 167 in the GC Rao Academy material. In that problem number 3. First you take down problem number 3. Read the question. From the following information, determine the appropriate weighted average cost of capital relevant for evaluating long-term investment projects of the company. From the following information, determine the appropriate weighted average cost of capital. They are asking cost of capital, that is overall cost of capital, relevant for evaluating long-term investment. Underline this. Long-term investment projects of the company. So only for the long-term investment projects they are asking. Below that they have given what is the return on investment, that is what is the cost of capital for each investment, that is each capital. What are the three different types of capital? Equity, preference and debt. So here cost of equity is 18%. After tax cost, see they have given after tax cost of long-term debt is 8%, and after tax cost of short-term debt is 9%. Here they are asking only long-term investment projects. They are not asking short-term. So this short-term should be eliminated. So next is cost of reserve, that is 15%. What is it mean by cost of reserve? Cost of reserve is nothing but suppose you have any retained earnings, that is reserves. You have kept a portion of profit as reserves. On that reserves, how much is the cost you are paying? That is 15% you are paying as cost for retaining those reserves. So all these three we should take into consideration. That is cost of equity. KE is equal to 18%, KD is equal to 8%, and KR, that is cost of reserve, is equal to 15%. So below that they have given what is the source of capital. That is equity capital, reserve, long-term debt, short-term debt. They have given book value and also they have given market value. So what is this book value and market value? Book value is nothing but value as per your books. That is equity. Equity, book value of the equity is nothing but at what value you have issued, that is face value. And if there is any reserves that has been retained, that will be taken into consideration in the book value. And long-term debt and short-term debt will be taken into consideration as per the issue price, that is at what price you have issued, that is the book value. Whereas market value is nothing but what is the value at which the particular capital has been sold in the market. That is, if suppose you are having equity share capital, then value of that equity share capital is 7,50,000. Then long-term debt is 3,75,000 and short-term debt is 1 lakh. So this is market value. They are asking us to find weighted average cost of capital under both the methods, that is book value and market value. So come to the notes. Record problem number 3. Problem number 3. Below that statement number 1. Calculation of overall cost of capital. Calculation of overall cost of capital, that is KO, within bracket KO hyphen. First we will calculate using book value, then we will calculate market value. So hyphen book value weights. They are given different values for each capital. So what you have to do is we should calculate what is the weights. So hyphen book value weights. First you are doing using book value. So below that put below that 1, 2, 3, 4, 5. Put 5 columnar table. Below that 5 columnar table. First column source. Second column book value. Third column weights. Fourth column KS. KS nothing but cost of different sources. So KS. And the last column is product. Below that book value record A. Below that book value record A. Below that weights record B. Below that weights record B. Below that KS record C. Below that KS record C. Below that product record D is equal to B into C. Below that record D is equal to B into C. Now this is 5 columnar table, that is source, book value, weights, KS, that is cost of source, different sources and product. So below that sources, leave one line gap and record capital. First they have given what source? Equity capital. So record equity capital. Equity capital. What is the book value of equity capital? They have given 3 lakhs. So in respect of book value, record 3 lakhs. Now below that record, what is the next capital, source of capital? They have reserve 2 lakhs. So in respect of source, record reserve and book value 2 lakhs. Book value 2 lakhs. And next what they have given, long term debt 4 lakhs. So below that reserve, record long term debt. Book value column, record 4 lakhs. Book value column, record 4 lakhs. So next what they are given is short term debt, but whereas we are evaluating the long term investment projects of the company, so we should not take into consideration this short term debt. So now book value total it. Book value total it 3 lakh plus 2 lakh plus 4 lakh, underline it, 9 lakh. So total value of book is, that is book value capital is 9 lakh. Book value total is 9 lakh. Now coming to the weights. What is this weights? Weights is nothing but comparing the weight of equity capital to the total capital is weights. That is how much of the equity capital is percentage on total capital. That is called weights. So record in respect of capital, that is in respect of equity capital, record 3 lakh divided by 9 lakh. You just take it down one calculation, then after that just take down the answers. Within bracket 3 lakh divided by 9 lakh. How much is the 3 lakh divided by 9 lakh? 0.333. In respect of equity capital, weights record 0.333. Below that, how much is the weight of reserves? 2 lakh divided by 9 lakh. 2 lakh divided by 9 lakh. Weight column record 0.222. 0.222. And in respect of long term debt, how much is the weights? 4 lakhs divided by 9 lakhs. So in respect of weights column record 0.445, because the total of weight should be 1. Here 0.333 plus 0.222, it is 0.555. So minus that by 1, that is 0.445. So normally if you calculate using calculator 4 lakhs divided by 9 lakhs, you will get 0.444. But the total of weight should be 1. So 0.445. 0.445. So these are the weights. So in respect of KS, now record. What is the cost of equity they have given? 0.18. That is in respect of equity capital, record 18%. In respect of equity capital, record 18%. Next, in respect of reserve, how much is the cost of reserve? 15%. So KS, in respect of reserve, record 15%. That is at 18% you are getting equity share capital, and at 15% you are getting reserves funds. And what is the long term debt? See, long term debt, they itself have mentioned after tax. If they have given before tax, that is if they have normally mentioned long term debt, cost of long term debt, then it is before tax. Then that before tax percentage into 1 minus tax rate, that only after tax cost of long term debt. Whereas here directly they have mentioned after tax cost of long term debt. So directly take this 8% to the cost of sources. That is in respect of that long term debt, record 8%. Now what is product? B is equal to B into C. So multiply weights into cost of sources. So in respect of equity capital, record 0.333 into 18% is equal to 5.994. In respect of equity capital, record 5.994. Below that reserve, weight is 0.222 into 15. 0.222 into 15. Product column record 3.33. Product column record 3.33. Now in respect of long term debt column, 0.445 into 8%. 0.445 into 8 is equal to, in respect of product column record 3.56. 3.56. So these are the different costs, that is multiplying the cost of different sources into weights of different sources, you will get what is the product of the sources. If you summarize it, you will get what is cost of overall cost of capital. So now total the product column. 5.994 plus 3.333 plus 3.56. Product column totally 12.884. Product column totally 12.884. So that is the overall cost of capital. So below that, therefore, KO is equal to 12.88%. 12.88%, which is nothing but cost of overall capital. So this is using book value weights. Now they have given market value weights also. Using that market value weights, repeat the same procedure. So below that, second statement number 2, calculation of overall cost of capital. Calculation of overall cost of capital, hyphen market value weights. Hyphen market value weights. Below that, 5 columnar table. Below that 5 columnar table, first column sources. First column sources. Second column book market value. Second column market value. Third column weights. Third column weights. Fourth column cost of sources, that is KS. And fifth column product. Fifth column product. Sources, market value, weights, KS and product. So below that sources, first record capital. Capital, how much is the capital? First record this capital. Below that reserves, and below that long-term debt. What are the different sources? Capital, then reserves, then long-term debt. Now see carefully. Equity share capital market value they are given as 7,50,000. Okay. Here the ratio of equity share capital and the reserves in the book value is 3:2. See, 3 lakh, 2 lakh. So total is 5 lakh. 3:2 is the ratio of equity capital and reserve. So this market value of equity share capital should be segregated into 3:2 as capital and reserves, and it should be accordingly calculated. So now find 7,50,000 into 3 divided by 5, that is 4,50,000. So in respect of capital column, market value record 4,50,000. Simple, that 7,50,000 should be issued, that is segregated into equity capital and reserves on the basis of the ratio, that is 3:2. So 4,50,000. Equity capital 4,50,000. And what is reserves? 7,50,000 into 2 divided by 5. That is 3 lakh. In respect of market value, reserves record 3 lakhs. 3 lakhs. And what is long-term debt they have given as market value? 3,75,000. So record in respect of long-term debt, market value is 3,75,000. 3,75,000. Now market value total it. Now market value total it. 4,50,000 plus 3 lakh plus 3,75,000. Amount column record 11,25,000. Amount column record 11,25,000. So based on this, calculate the weights. Third column, that is weights. 4,50,000 for in respect of equity capital, 4,50,000 divided by 11,25,000. That is 0.4. In respect of equity capital, record 0.4. How you should calculate the weights? Equity capital, that is capital amount 4,50,000 divided by total amount 11,25,000. You will get what is weights for all three sources, that is capital, reserve and long-term debt. So below that record 3 lakhs divided by 11,25,000. How much is it? 0.27. 0.27. And below that long-term debt 3,75,000 divided by 11,25,000. 3,75,000 divided by 11,25,000. Weights column record 0.33. 0.33. So these are the different weights: 0.4, 0.27 and 0.33. So what is KS? KS is same as per the book value. Cost of equity is 18%. In respect of KS, for capital record 18, for reserves record 15, and for long-term debt record 8, because it is after tax. If it is before tax, this 8 into 1 minus tax rate. If it is after tax, directly take this 8%. So in respect of KS column 18, 15 and 8. Now multiply both weights and KS, you will get what is the product. So 0.4 into 18, 0.4 into 18, product column record 7.2 for capital, 7.2. In respect of reserve column 0.27 into 15, 0.27 into 15, product column record 4.05. In respect of long-term debt 0.33 into 8, 0.33 into 8. Product column record 2.64. 2.64. So now product column total it. 7.2 plus 4.05 plus 2.64. In respect of that, total 13.89. 13.89. That is the overall cost of capital as per market value. So below that, therefore, KO is equal to 13.89%. KO is equal to 13.89%. With this, we have completed problem number 3. So now moving on to problem number 4. Problem number 4. In considering, read the question. In considering the most desirable capital structure of a company, that is, while considering the most desirable capital structure is nothing but how much of debt equity mix should be there. That is the desirable capital structure. So the following estimates of the cost of debt and equity capital, both are after tax, have been made at various level of debt equity mix. Simple. What they did is they are asking us to find which is the best cost of best debt and equity mix as per this particular cost. So here they have given cost of debt and cost of equity, and they have also given what is debt equity mix. So now find out what is the best overall cost of capital. We should find cost of capital using that weights formula for all these 6-7 situations, so that we can find where the overall cost of capital is less. That is the best debt equity mix. So they have given different debt to capital employed, that is debt as a percentage of capital employed formula, debt to total funds percentage, and cost of debt they have given, cost of equity they have given. Both are after tax. So you are required to determine the optimum debt to equity mix for the company by calculating composite cost of capital. First you should calculate what is cost of capital using the cost of equity into weight of equity and cost of debt into weight of debt formula. And then what you should do is where the cost of capital is very low, that is the best debt to equity mix. So now come to the solution. Put that in problem number 4. Problem number 4. Statement number 1. Calculation of optimum capital structure. Calculation of optimum capital structure. Below that record, what is the formula which we studied for the calculating the overall cost of capital using the weights? Cost of debt into weight of debt plus cost of equity into weight of equity. That is the overall cost of capital formula. So below that record, KO is equal to open a bracket, KD into WD. That is, KD means cost of debt, which is after tax cost of debt. You should always take after tax cost of debt. You should not take before tax cost of debt. If they have given before tax, deduct interest tax amount, that is 1 minus into that cost of debt, pre-tax cost of debt into 1 minus tax rate. If you do, you will get after tax cost of debt. But here they have given cost of debt is after tax directly, so you don't have to do all those things. So within bracket, KD into WD, close the bracket, plus open a bracket, KE into WE, close the bracket. So cost of debt into weight of debt plus cost of equity into weight of equity. That is called overall cost of capital. That is called overall cost of capital. So below that, we should go one by one. That is, for all 7 situations, we should find what is overall cost of capital. Below that record, point number 1. What is the cost of debt here? 5. KD is cost of debt. KE is cost of equity. And weight of debt they have given 0. Then weight of equity is 1. If weight of debt is 10, then weight of debt should be taken as 0.1 and weight of equity should be taken as 0.9. They have given debt to total employed, capital employed percentage here. If it is 10% here, then 90% is equity. If it is 20% here, 80% is equity. Like that you should consider. So point number 1, within bracket, open a bracket, cost of debt is 5% into what is the weight of debt? 0. So 5 into 0 plus open a bracket. What is the cost of equity? 12. So 12 into 1. What is the weight of equity? If it is 0, then weight of equity is 1. So 12 into 1. Close the bracket. So is equal to 5 into 0 is 0. 1 into 12 is 12. So total is 12%. Is equal to 12%. Is equal to 12%. That is the overall cost of capital under situation 1. So below that, leave one line gap, record. Point number 2. What is the weight of debt? 10%. So 0.1. So 0.1 into, open a bracket, 0.1 into what is the cost of debt at 10%? 5%. That is at 10 that is 10 is to 90. At 10 is to 90 debt mix, cost of debt is 5, cost of equity is 12. So 5, 0.1 into 5 within bracket plus, if it is 10, if 10% is debt, 90% is equity. So plus, open a bracket. What is the weight of equity? 0.9 into 0.9 into what is the weight of cost of equity under 10 is to 90 mix? 12%. So into 12. Into 12. Now close the bracket. Is equal to, now calculate 0.1 into 5 plus 0.9 into 12. You are getting 11.3 is equal to 11.3%. Is equal to 11.3%. That is overall cost of capital under situation 2. Now see the situation 3. That is 20 is to 80 debt mix, debt equity mix. So if debt is 0.2, equity is 0.8. So record point number 3. Point number 3, 0.2 into what is the cost of debt? 5. Within bracket 0.2 into 5 plus 0.8 into 12.5. 0.2 into 5 within bracket plus within bracket 0.8 into 12.5 is equal to, calculated, 0.2 into 5 plus 0.8 into 12.5 is equal to 11%. So is equal to 11%. That is overall cost of capital under situation 3. Now below that record point number 4. Below that record point number 4. 30 is to 70 mix. So cost of debt is 0.3, cost of equity is 0.7. So record point number 4. Within bracket 0.3 into 5.5 plus within bracket 0.3 into 5.5, close the bracket plus, now again within bracket 0.7 into how much is the cost of capital, cost of equity 13. So 0.7 into 13, close the bracket. Open the bracket, 0.7 into 13 and close the bracket. So that is the mix of debt equity under situation 4. So now I calculate the answer. 0.3 into 5.5 plus 0.7 into 13. You are getting 10.75. So is equal to 10.75. That is the overall cost of capital under situation 4. Now situation 5 is 40 is to 60. 0.4, 0.6. 0.4 is debt. 0.6 is equity. So below that record, point number 5. Point number 5. With open a bracket, 0.4 into 6. Close the bracket. 0.4 into 6 within bracket plus 0.6 into what is the cost of equity? 14. 0.6 into 14. So now calculated. 0.4 into 6 plus 0.6 into 14 is equal to 10.8%. Is equal to 10.8%. That is the overall cost of capital under situation 5. So under situation 6, what is the debt equity mix? 0.5. That is 50-50%. So 0.5 is the debt mix. 0.5 is debt. 0.5 is equity. So record point number 6 within bracket 0.5 into 6.5 within bracket 0.5 into 6.5, close the bracket plus 0.5 into 16. 0.5 into 16. Now calculate it. What is 0.5 into 6.5 plus 0.5 into 16? You are getting 11.25. 11.25. Now below that last situation, that is situation number 7. 60 is to 40. That is weight of debt is 0.6 and weight of equity is 0.4. Now take down. Open a bracket. Point number 7. Open a bracket. 0.6 into 7. 0.6 into 7 plus 0.4 into 20 plus 0.4 into 20. So now calculate this. 0.6 into 7 plus 0.4 into 20. You are getting 12.2. So overall cost of capital is 12.2%. Under situation 7, overall cost of capital is 12.2%. So now what they have asked us to calculate? They have asked us to calculate what is the optimum debt to equity mix. How will you calculate which is the best equity mix here? For every 1 rupee of capital which you are procuring and utilizing, you have to spend less cost so that you will be expending very less amount as cost of capital. That is the best debt equity mix. Here where the cost is very less, cost is less at 10.75%. That is for every 1 rupee, that is you are incurring 10.75% as cost. That is the lowest debt to equity mix. That is situation number 4. Situation number 4 is 30 is to 70. That is debt should be 30%, in equity should be 70%. So optimum debt to equity mix is 30 is to 70. So below that record comment. Below that record comment. the overall cost of capital, the overall cost of capital is comparatively lower at 10.75%. The overall cost of capital is comparatively lower, that is 10.75%, when debt is 30%, when debt is 30% and equity is 70%, full stop. Hence 30 is to 70 should be considered as optimum capital structure. We can even take it as, don't take it as optimum capital structure, can be considered as most desirable debt versus equity mix. The capital structure should be 30 is to 70. That is, equity should be 70, debt should be 30, so that your overall cost of capital will be very low, so that your profits can be more. So that is problem number 4. So with that, we have completed problem number 4. Moving on to next problem, that is problem number 1. Problem number 1. To understand the formulas, you are doing this problem. See what they have given. Assuming the corporate tax rate of 35%, compute the after-tax cost of capital in the following situations. They are asking us to calculate after-tax cost of capital in the following situations. That is, they have given two situations, different situations. You have to calculate what is the after-tax cost of capital. That is, both they have given debentures. So they are asking us to calculate after-tax debentures, cost of debenture. So first read the situation 1. Perpetual 15% debentures of 1000 sold at a premium of 10% with no flotation cost. See, it's a perpetual debentures. That is, it is not redeemable. So it is a perpetual debentures, irredeemable debentures, that is issued at 15% debenture. Interest rate is 15%. You are issuing 1000 debentures. Value of 1000 rupees per debenture. So it is sold at premium of 10%. That is, 1000 rupees debenture is sold at 1000 into 110%. That is 1100%. 1100 rupees you are selling each debentures with no flotation cost. So if there is no flotation cost, how much is the cost of capital? Your cost of debt, that is after tax cost of debt, that they are asking. What is the formula for this? If there is irredeemable debentures, interest into 1 minus tax rate divided by net profits into 100. Here interest into 1 minus tax. How much is the interest? 1000 into 15%. So 1000 into 15% is 150 into what is the tax rate? 35%. 1 minus tax rate is 65%. So into 65%, that is 97.5 divided by what is the net profits? 1000. You are getting at premium of 10%. So 1100 divided by 1100 into 100. That is 8.86% is the after tax debenture cost of debenture. So record. Come to the problem. Record problem number 1. And record, put that in case number 1. Case 1. Case Roman number 1. Record. What is the KD? Write the formula KD. Here they have given refer problem number 10, but we will take down the answer itself. Take down. KD is equal. Take down the formula first. KD is equal to interest into interest within bracket 1 minus tax rate. Interest 1 into 1 minus tax rate within bracket divided by net profits NP, net profits into 100. Interest divided by interest into 1 minus tax rate divided by net profits into 100, because it is irredeemable debentures. If it is irredeemable debentures, the formula is interest into 1 minus tax rate divided by net profits into 100. So here calculate one by one. First, what is the interest here? Interest is 1000 into 15%. Now record. Below that record is equal to interest is 150. That is equal to 150, open a bracket, 150 into open a bracket 1 minus 0.35, close the bracket, 1 minus 0.35, close the bracket. Now leave 2 lines gap below that record. NP, net profits is equal to NP is equal to 1000 into 110%. 1000 into 110%, because it is sold at a premium of 10%. So NP is equal to 1000 into 110% is equal to 1100. 1100. Now come to the formula. Come to the solution. 150 within bracket 1 minus 0.35 divided by 1100 into 100 divided by 1100 into 100. So calculate it. 150 into 1 minus 0.35 is 0.65 into 0.65 divided by 1100 into 100. You are getting 8.86. Below that is equal to KD is equal to 8.86%. 8.86%. That is irredeemable debentures. So KD is equal to 8.86%. We have finished problem number case number 1. Now below that below that net profits record. Small Roman number 2. That is case 2. What is they have given case 2? 10-year 14% debentures of 2000 redeemable at par with 5% flotation cost. Here they have mentioned that number of years for the redemption is 10 years. 14% debentures. Value of debentures at which is sold is 2000 and redeemable at par. That is, you are redeeming it at 2000 rupees only. That is, it is redeemable at par with 5% flotation cost. That is, when you are issuing the debentures, you are incurring 5% flotation cost. So, what is it? We have found that it is redeemable debentures. What is the formula for redeemable debentures? Interest into 1 minus tax rate plus redemption value within bracket redemption value minus net profits divided by n whole divided by redemption value plus net profits divided by 2 into 100. That is the formula for redeemable debentures. So now we should apply that using this formula. Then you should calculate what is the cost after tax cost of debt. So in respect of that small Roman number 2, record KD is equal to, take the formula, KD is equal to interest within bracket 1 minus tax, interest into 1 minus tax plus within bracket RV minus NP divided by N. RV minus NP divided by N. RV means redemption value, NP means net profits, N means number of years. So RV minus NP divided by N, close the bracket, whole divided by RV plus NP divided by 2. RV plus NP divided by 2. RV plus NP divided by 2 into 100. Into 100. So we have calculated, we have taken what is the formula for it. So now calculate. First calculate what is interest. For 2000 rupees, 14% debentures. So 2000 into 14%, that is 280 is the interest. So record is equal to 280 with open a bracket, 280 into open a bracket 1 minus 0.35, 1 minus 0.35, close the bracket, because tax rate they have given is 35%. So 1 minus 0.35, close the bracket, plus again open the bracket. So what is the redemption value? Redeemable at par they have given. At par is nothing but at the same value. At premium means at a premium, more value. Like 2000 rupees redeemable at 10% means at 10% more value. 2000 rupees redeemable at a discount means at less value. Here they have given redeemable at par, that is at the same value. So redemption value is 2000. Redemption value is 2000. So open a bracket, 2000 minus, what is the net profits? Leave 5 lines gap, record. Leave 5 lines gap, below that record NP is equal to, the flotation cost is 5%. So NP is equal to 2000 minus, how much is the flotation cost percent? 5%. 2000 minus, what is 2000 into 5%? 100. So 2000 minus 100. NP is equal to 2000 minus 100. Flotation cost should always be calculated at the value of debentures at which it is sold. So 2000 into 5% is 100 rupees. So 2000 minus 100 is equal to 1900. 1900, that is net profits. So now coming to the solution, come to the formula, 2000 minus 1900 divided by N. N means number of years. Here they have given 10-year debentures. So divided by 10 and close the bracket. 2000 minus 1900 divided by 10 and close the bracket. Then close the bracket, whole divided by, what is the redemption value? Redeemable at par, that is 2000. Net profit is 1900. Now add both. 2000 plus 1900 divided by 2. 2000 plus 1900 divided by 2 into 100. Into 100. So now record it. 280 into 1 minus tax rate, that is 1.35. So 280 into 0.65. You are getting 182. 182. Again 2000 minus 1900. 100 divided by 10, that is 10 plus 10, that is 192 divided by 2000 plus 1900 divided by 2 is 1950 divided by 1950 into 100, that is 9.85%. So is equal, below that record is equal to 9.85%. See, if you are going step by step also, it's more than, like it is recognizable. If you are going step by step, that is 280 into 1 minus tax, 1 minus 0.35. You should record 280 into 0.65, that is 182 plus 10 divided by 190. So that is, sorry, 1950 into 100. Then if you write this 9.85%, you are going step by step. Here they have gone, like they have did calculations using the calculator and they have given the answer 9.85%. You can go by step to not get confused. Below, in between this, you can put 182 plus 10 divided by 1950 into 100, so that you will get 9.85%. Going step by step is preferable. Is equal to 9.85%. That is case 2. We have found case 1 value and case 2 value. That is problem number 1. The both are after tax cost of debt. So with that, we have finished problem number 1. So now moving on to next problem. That is problem number 5. Moving on to next problem, that is problem number 5. Take page number 168, problem number 5. Determine the weighted average cost of capital using book value weights, market value weights. Again, same thing. They are asking us to calculate what is the weighted average cost of capital using book value weights and market value weights based on the following information. They have given what is book value structure. That is, debentures book value is 8 lakhs, preference share book value is 2 lakhs, equity share book value is 10 lakhs. So total of 20 lakhs. Recent market price of all these securities are debentures. See, market value also they have given 110 per debenture. Here 8 lakhs of total debenture value divided by per debenture value is 100. You are getting 8,000 debentures into 110. So 8,80,000 is the market value of debentures. Like that, you should calculate what is the market value for all three: debentures, preference shares, and equity shares. So both we have, that is book value capital structure and market value capital structure we have found. But here, what they have not given, which they gave in the problem number 3 is, see, while doing problem number 3, same sum, they have given directly what is the cost of equity, what is the after tax cost of long term debt, what is cost of reserve. They have given these percentages directly, where in problem number 5 they have not given the percentages. So you should apply that KD formula, KP formula, and KE formula and calculate what is the cost of equity, cost of debt, and cost of preference share. Then you should apply it in the weights, that is book value weights and market value weights, and find overall cost of capital using book value weights and market value weights. So this is problem, exam problem with 8 to 10 marks, 8 to 12 marks. They'll ask this problem. So this is actually exam problem, full-fledged exam problem. So here they have given what is book value weights, what is market value values, and then they have asked us to calculate what is the cost of equity, cost of debt, and cost of preference. First, we need what is cost of equity, cost of preference, and cost of debt, so that using that cost values, we can multiply the weights and calculate overall cost of capital. So record. Come to the notes. Problem number 5. Problem number 5. First, we should calculate what are the different cost of equity, cost of debt, and cost of preference. We should calculate the percentages. Then only we can multiply with the weights and calculate what is overall cost of capital. So come on. Problem number 5. Statement number 1. Calculation of specific cost of capital. Calculation of specific cost of capitals. Statement number 1. Calculation of specific cost of capital. Below that, capital A. First we will calculate. First they have given in A debentures. In B they have given preference shares, and C equity shares. So capital A, cost of debt. First we are calculating cost of debt. Read the question. What is A point they have given? Rupees 100 per debenture, redeemable at par. So it is a redeemable debenture. We should use this redeemable debentures formula. That is, we should use RV minus NP divided by N formula. Then number of years is 10. Interest rate is 13%. Flotation cost is 4%. Sale price is 100 rupees. That is, it is sold at 100 rupees. That is, net profits is 100 rupees. Net profits we should calculate 100 rupees minus this 4% on floating cost. You will get what is net profits. So using this, we can calculate what is cost of debt. No. So come to the problem. And corporate tax rate they have given is 50%. So take down. capital A, cost of debt, below that take the formula after tax KD, that is KD is equal to interest into interest open a bracket 1 minus tax rate, interest within bracket 1 minus tax rate plus 1 minus tax rate plus open a bracket redemption value RV minus NP divided by N, close the bracket, RV minus NP divided by N, redemption value minus net profits divided by number of years, close the bracket, whole divided by open a bracket redemption value plus net profits divided by 2, redemption value plus net profits divided by 2 into 100. This is the redeemable debentures formula. So interest into 1 minus tax rate plus redemption value minus net profits divided by N, whole divided by redemption value plus net profits whole divided by 2. So into 100. This is the formula. Here different things we should find. What is interest? See, 100 per debenture. So 100 into cost of debentures, that is total debenture value is 100 per unit. That is per debenture is 100 into 13% is the coupon rate. So 13 rupees is the interest. So interest is below that record. Interest is equal to 13. Interest is equal to 13. Redemption value. What is the redemption value? Here debentures are redeemable at par. 100 per debenture are redeemable at par. At par means at the same value. So redemption value is equal to 100, comma net profits is equal to how much value 100 per debenture and flotation cost is 4%. So 100 into 4%, 100 into 4%, that is 4 rupees. So net profits is equal to 100 minus 4. Net profits is equal to 100 minus 4 is equal to 96. Is equal to 96. Now take the formula. Take this all this value to the formula. Record is equal to below that is equal to what is interest? 13. 13 within bracket open a bracket 1 minus 0.5, tax rate is 50%. So 1 minus 0.5 close the bracket plus 13 open a bracket 1 minus 0.5 close the bracket plus 100 minus 96 divided by 10. 10 number of years is 10. So 100 minus 96 divided by 10 close the bracket. Now whole divided by open a bracket 100 plus 96 divided by 2 close the bracket. 100 plus 96 divided by 2 close the bracket. Outer put into 100 into 100. How much the value you are getting? See, just calculate 13 into 1 minus 0.5 is 0.5, so 6.5 plus 100 minus 96 divided by 10, that is 4 by 10 is 0.4 divided by 100 plus 96 divided by 2 is 98 into 100, that is 7.04%. Below that record KD is equal to 7.4%. So now record next. Below that leave a line gap. B, small b, cost of preference share capital. Leave a line gap. KP is equal to PD plus what is the cost of preference? First we read the question. What they have given 100 per preference shares redeemable at par. So it is also redeemable preference shares. Okay, it is also redeemable preference shares. 10 years maturity. So number of years is 10. 14% dividend rate and 5% flotation cost. Sale price is 100. So same formula, same calculations. But the difference is there is no 1 minus tax rate and it is 14% dividend rate. So below that record KP is equal to PD plus open a bracket. PD plus that is preference dividend plus open a bracket redemption value minus net profits divided by N close the bracket, redemption value minus net profits divided by N close the bracket, whole divided by redemption value plus net profits divided by 2, redemption value plus net profits divided by 2 close the bracket into 100. Now take down one by one values. What is the preference dividend? 14% on 100 rupees, that is 14. Below that is equal to 14 plus what is the redemption value? Redemption value is 100 redeemable at par. So 100 open a bracket 100 minus what is the net profits? 100 minus 5 rupees, that is 5%. So 5 rupees, so 95. 100 minus 5 whole divided 100 minus 5 divided by 10 because 10 year maturity. 100 minus 5 divided by 10. Now close the bracket whole divided by 100 plus 95 divided by 2 within bracket, open a bracket, 100 plus 95 divided by 2, close the bracket, into 100. Now calculate. 14 plus 100 minus 95, that is 5 divided by 10, that is 0.5. 0.5 divided by 100 plus 95 divided by 2, that is 97.5 into 100. So 14.87%. Below that is equal to KP is equal to 14.87%. 14.87%. Now below that small c, cost of equity. Now read what is cost of what they are given for cost of equity. Equity shares 2 per share flotation cost. Equity share hyphen 2 per share flotation cost. That is, for every equity share you are incurring 2 rupees per share as flotation cost, and sales price is 22 rupees. So out of 22 rupees, if you deduct 2 rupees, 20 rupees is the net profits. And dividend expected on equity shares at the end of the year is 2. So dividend expecting is 2 and net profits is 20. And anticipated growth rate in dividend is 7%. So total growth rate is 7%. G is equal to 7. And company pays all its earnings in the form of dividend. So there is no retention ratio. Everything is paid as dividend. So growth rate is 7%. So every year there will be a growth in dividend rate of 7%. So corporate tax is 50%. Corporate tax is 50%. So now they have given dividend formula, and in dividend itself there is some growth. So dividend plus growth, what is the formula? Dividend divided by net profit, that is PO into 100 plus growth, that is the dividend plus growth formula. If you go and check the formulas which we have written, dividend plus growth formula is dividend divided by PO into 100 plus growth. So below that, take down KE, cost of equity, is equal to dividend divided by PO into 100, close the bracket, plus growth, close the bracket, plus growth, close the bracket, plus growth. Now take down what is the dividend. Dividend is 2 per share at the end of the year. And what is the PO? PO means what is the net profits at the beginning. So 22 minus 2, that is 20. So below that record 2 divided by 20, 2 divided by 20 into 100, close the bracket, 2 divided by 20 into 100, close the bracket, plus what is the growth of dividend? 7%. So what is calculated? 2 divided by 20 into 100, that is 10%. So 10 plus 7. Below that record 10 plus 7. 10% plus 7% is equal to 17%. So here we have found what is cost of equity, cost of preference, and cost of debt. Now moving on to next thing, that is using the weights you can find what is the overall cost of capital for both market and book value. Market value and book value. Now take down below that, take down statement number 2. Statement number 2, calculation of overall cost of capital. Calculation of overall cost of capital using book value. They have asked us to find both book value and market value. First book value we'll find, they have given directly, and market value we should find the values, and then we can find what is the weights and multiply it with the cost of sources, different sources of capital which we found in the above statement number 1. If we multiply with it, we'll get product, summation of that is overall cost of capital. Same like problem number 3 hereafter. We have found all 3 cost of sources. So calculation of overall cost of capital hyphen book value. Below that 5 columnar table. Below that 5 columnar table, first column source, second column BV, that is book value, third column weights within bracket A, fourth column KS, that is cost of different sources within bracket B, and last column product. C is equal to A into B, within bracket C is equal to A into B. So what are the different sources now? Under sources record debentures, first arrow mark debentures, below the second arrow mark preference share capital, and below the third arrow mark equity share capital. Now copy the book value weights, all 3 weights. What is the book value weight of debentures? 8 lakhs, preference shares 2 lakhs, and book value 10 lakhs. And book value 10 lakhs, 8 lakhs, 2 lakhs, and 10 lakhs. Now total the book value 8 lakhs plus 2 lakhs plus 10 lakhs. Total it below that record 20 lakhs. Below that record 20 lakhs. Under weights, now calculate weights. How should we calculate weights? Each book value divided by total weight, that is 8 lakh divided by 20 lakh, that is 0.4. 8 lakh divided by 20 lakh, that is 0.4 in respect of debentures, and 2 lakh divided by 20 lakh, 0.1 in respect of preference share capital, 0.1, and equity share capital is 10 lakh divided by 20 lakh. Weights in respect of equity share capital is 0.5. Just calculate what is 10 lakh divided by 20 lakh into 100, that is 0.5. So this is the weights 0.4, 0.1, and 0.5. Now KS just take down from the above statement which you have taken, which you have calculated. Cost of debt is 7.04%. Cost of debt is 7.04%. Then cost of preference share capital is 14.87%. 14.87%, and cost of equity share capital is 17%. In respect of the KS column record 7.04, 14.87, and 17. Now if you multiply A into B, you will get product. Now, so multiply A into B. 0.4 into 7.04, in respect of product column record 2.80. Then 0.10 into 14.87. 0.10 into 14.87. In respect of product record 1.49. Then 0.5 into 17. In respect of product column record 8.5. Now totally 2.8 plus 1.49 plus 8.5. Product column totally 12.81%. 12.81%. In respect of the 12.81% record KO. In respect of the 12.81% record KO. So this is the overall cost of capital under book value weights. Now below that, take down statement number 3. Leave one line gap and take down statement number 3. Market value. Put the heading market value. Market value. Same, divide the column into 5 column table. That is first column sources, second column MV, third column weights, fourth column KS, and fifth column product. Sources, MV, weights, KS, and product. Below the sources record debentures, preference share capital, and equity. One by one record debentures, below that preference share capital, and below that equity. In respect of that market value record, how much is the market value they have given? 110 per debenture. So total number of debentures, how much? 8 lakhs divided by, calculated using book value. 8 lakh of book value divided by 100 per share. So divided by 100, you are getting 8,000 shares, 8,000 debentures into 110 per share is the market value. So 8 lakh 80. So in respect of debentures record 8 lakh 80,000. In respect of debentures record 8 lakh 80,000. Just you should calculate number of debentures and multiply with the market value. You will get what is the market value of debentures. Preference share capital also do the same thing. Book value is 2 lakhs. Book value per share is 100. If you divide 2,000 shares into 120 per share, so 2,000 into 120, you are getting 2 lakh 40,000. In respect of preference share capital record, market value 2 lakh 40,000. 2 lakh 40,000. And next equity share capital also same thing. 10 lakhs book value divided by 10 rupees per share. That is 1 lakh shares. Total 1 lakh shares. What is the market value per share? 22. 1 lakh into 22, you are getting 22 lakhs. So in respect of equity record, 22 lakhs. Now, equity total it, all the market value totally 22 lakhs plus 2 lakh 40,000 plus 8 lakh 80,000. You are getting 33 lakh 20,000. Now, market value totally 33 lakh 20,000. 33 lakh 20,000. In respect of weights, calculate. Now, divide the debenture market value by total market value. That is 8 lakh 80 divided by 33 lakh 20,000. You are getting 0.265. In respect of debentures record 0.265. 8 lakh 80 divided by 33 lakh 20,000. 8 lakh 80,000 divided by 33 lakh 20,000. You are getting 0.265. And preference share capital. Preference share capital 2 lakh 40,000 divided by 33 lakh 20,000. 2 lakh 40,000 divided by 33 lakh 20,000. You are getting 0.072. 0.072. And equity 22 lakhs divided by 33 lakh 20,000. 22 lakhs divided by 33 lakh 20,000. You are getting 0.663. 0.663. So if you summation of all these weights, you will get 1. So now, what is KS? What we recorded in the, what we calculated in the statement number 1, that is 7.04 for debentures. In respect of debentures 7.04. In respect of preference share capital 14.87. And in respect of equity 17. 7.04, 14.87, and equity is 17. Now multiply weights with the cost of sources, cost of different sources. You will get what is product. So 7.04 into 0.265. You are getting 1.87. 1.87 in respect of debentures. Then preference share capital is 14.87 into 0.072. 14.87 into 0.072, 1.07. 1.07. Next is equity 17 into 0.663. 17 into 0.663. You are getting 11.27. 11.27. Now total it. 1.87 plus 1.07 plus 11.27. You are getting 14.21. So total amount column record. Total the product record 14.21. 14.21. In respect of that 14.1 record, KO, that is cost of overall cost of capital, KO is 14.27% in respect of market value. So we have found what is cost of equity, cost of debt, and cost of preference share capital. Using all those three things, you have find what is the overall cost of capital under book value weights and under market value weights. So that is problem number 5. So next is problem number 6. Same thing again. Actually, you can do problem number 6. I think no, we'll do. There is little bit calculations of cost of equity. In respect of cost of equity, we should do some calculations. Okay. Now see problem number 6. Present capital structure of a company is as follows. The capital structure of the company they have given. Equity capital, this is book values. Equity capital is 2,40,000. Face value is 10 rupees per share. Reserves 3,60,000. Then 11% preference shares is 120. Then 12% debentures 120 and 14% term loan is 360. All these are capital structure, present capital structure. Additionally, the following information are available. Company's equity beta is 1.06. So using this CAPM formula, that is capital asset pricing model, risk RF plus beta into RM minus RF, you can calculate what is the cost of equity. So cost of equity we can find using this company beta. And yield on long-term treasury bonds, that is nothing but RF. So stock market risk premium, that is nothing but RM minus RF. So using this all three, you can easily find what is cost of equity. And cost of preference is 11 and cost of debentures is 12. But this cost of debentures is before what is that? Before tax rate. So you should calculate what is after tax debentures rate and after tax term loan. So next what they have given is current ex-dividend equity share price, that is market price of equity shares and market price of preference shares and market price of debentures, and also they have given corporate tax rate, that is 40%. The debentures are redeemable. So the debentures are redeemable after 3 years. So it is a redeemable debentures and interest is paid annually, ignoring flotation cost. So there is no flotation cost. Calculate the company's weighted average cost of capital. It is asking us to calculate what is the company's weighted average cost of capital. Done. So using this, first we should calculate what are the different costs of capital, and then we should calculate what is the weighted average cost of capital. So take down. Come to the solution. Problem number 6. All these are book values, man. Okay, all these are book values. Now using this, we should calculate what is the market values. So using the market values, you should calculate what is the overall cost of capital. Overall cost of capital we should find for both book value and market value. Okay, done. Now come to the solution. Problem number 6. Problem number 6. Put that in. Statement number 1. Calculation of specific cost of capital. Calculation of specific cost of capital. Below that, record capital A cost of equity. Capital A cost of equity. First we should find out what is cost of equity, then cost of preference share capital, then cost of debentures. Then we can move on to all the other overall cost of capital. So first capital A cost of equity. What is cost of equity? How can we find here? Here they have given beta. That is, first is they have given beta, then they have given RF, and they have given RM minus RF. Using this all three, you can easily find using CAPM what is RE. So that is KE. So below that cost of equity, record CAPM within bracket, then KE is equal to RF plus beta within bracket RM minus RF. Beta into within bracket RM minus RF. Below that is equal to, what is the RF they have given? RF is nothing but risk-free rate of return. Here long-term treasury bonds, there is no risk. If you put 10 lakh rupees, there is no risk at all. You will be getting 10% return. So that is called risk-free rate of return. So RF means 10. RF they have given 10 plus, what is the beta they have given? 1.06 within bracket RM minus RF is 6%. So 6. They have given directly what is RM minus RF. But here what they have done is They have calculated RM by calculating RF plus that 6, that is 16. Then again they are deducting 16 minus 10. So what is this RM minus RF? 6%, that is risk premium. So directly within bracket put 6. Within bracket directly put 6. RM minus RF is nothing but risk premium. So within bracket 6. Now 1.06 into 6 plus 10, you are getting 16.36. So below that is equal to 16.36%. That is cost of equity. This is called CAPM model of calculating cost of equity. So KE is 16.36%. They'll give what is R of man and they'll give what is beta, and either they'll give what is RM or risk premium. If they give RM, take that. If they suppose instead of giving risk premium they give RM 16%, then what you should do is 16 minus RF is 10. So 6. You should calculate using that. Here they have given directly risk premium. So 6% is RM minus RF. So directly they have deducted RM from RF. Then they have given 6%. So within bracket put 6. Multiply it with beta, then add the risk-free rate, then you will get cost of equity. This is how you should calculate cost of equity using CAPM model. So next below that, capital B, cost of preference share capital. Cost of preference share capital. Cost of preference share capital. There is no flotation cost. See, there is no flotation cost. Okay. See, 11% preference shares, face value is 10, total value is 120. So net profit is 120 and face value is 10 and interest rate is 11%. That is preference dividend rate is 11%. So below that capital B, cost of preference share capital. Here there is no flotation cost and preference share capital are irredeemable. They didn't tell it is redeemable. So directly record below that KP, cost of capital is equal to preference dividend divided by net profits into 100. Preference dividend divided by net profits into 100. What is the preference dividend? Face value is 10 into 11%, that is 1.1. So you should always calculate the dividend on the face value. That is whatever your face value, on that only they will issue dividend. So your face value is 10 and dividend is 11%. So 10 into 11%, that is 1.1 divided by what is the net profits? Net profits is 120. 120 divided by 10, you will get again 12. So 1.1 divided by 12. So total value of preference shares is 120 as per book value. Face value is 10. If you divide, you will get net profits, that is 12. 1.1 divided by 12 is equal to 9.17% into 100 is equal to 9.17%. 9.17%. 9.17%. So you have calculated what is cost of preference share capital. Now we should also calculate what is cost of debentures and cost of term loans. So below that record capital C, cost of debentures. Capital C, cost of debentures. Here debentures they have directly given, it is redeemable debentures of 3 years. So we should use redeemable debentures, cost of redeemable debentures formula. So cost of debentures, below that KD is equal to, take down the formula, KD is equal to interest into 1 minus tax rate, interest into 1 minus tax rate plus within bracket RB minus NP divided by N, that is redeemable value, redemption value minus net profits divided by N, whole divided by redemption value plus net profits divided by 2, whole divided by redemption value plus net profits divided by 2 into 100. Into 100. What is the debentures value here? 120 into 12%. See, debentures value is 120. Okay. Debentures value is 120. So interest rate you are going to get is 12. So 120 into how did you get that 12 as interest rate? That you should know. Here 120 they have given total value, but 12% debentures. See here current X interest debentures market value is 102.5 per 100 rupees. So 100 rupees is the book value. On that 102.5 is the market value. So here 12% debentures of 100 each has been issued for 120 million. So interest is 100 into 12%, that is 12 within bracket 1 minus what is the tax rate? 0.4. So 1 minus 0.4 within bracket plus what is the redemption value? 102.5. Net profits is 100. There is no floating cost. So net profits is 100. You are going to redeem at 102.5. net proceeds is 100 rupees. So within bracket 102.5 minus 100 divided by 3, because it is 3-year redeemable debentures, divided by 3, close the bracket, whole divided by 102.5 plus 100 divided by 2. 102.5 plus 100 divided by 2 into 100 into 100. Now calculate it. 12 into 0.6 plus 102.5 minus 100 divided by 3. You are getting 0.833 plus 12 into 0.6, that is 7.2, divided by 102.5 plus 100 divided by 2, that is 101.25, divided by 101.25 into 100. You are getting 6.29%. 102.5 plus 100 divided by 2. 102.5 plus 100 divided by 2, you are getting 101.25. So below that is equal to KD is equal to 6.29. 6.29%, that is cost of debentures. So we have calculated cost of debentures using redeemable debentures cost. Redeemable debentures formula. Next is below that small d, cost of term loan. Here term loan is also considered as capital structure. So cost of term loan, very simple. Term loan, what is the value into 14%? That is 14% into 1 minus tax rate is the cost. So cost of term loan, KTL is equal to interest into 1 minus tax rate. Interest into 1 minus tax rate. So for every 1 rupee, you are going to get 14% term loan. So 14 is the interest into 1 minus 0.4. 14 within bracket 1 minus 0.04. 0.4 is equal to 8.4%. Cost of term loan is 8.4%. You should always calculate using 100, that is 1 rupee. For every 1 rupee, you are going to get 14. So interest is 14%, is 14. So that is how you should calculate the per unit value. Okay, done. So here cost of term loan is 8.4%, cost of debentures is 6.29%, cost of preference share capital we have calculated 9.17%, and equity we have calculated 16.36%. With this we can calculate using different book values and market values. So below that, take down statement number 2, calculation of cost of capital -BV. Calculation of KO -BV. Below that 5 column table, first column source, second column BV, third column weights, source BV weights, fourth column KS, that is cost of different sources KS, and last column product. Last column product. Below that sources record. Below that sources record equity, first arrow mark equity, second arrow mark preference share capital, third arrow mark debentures, and fourth arrow mark term loan. Equity, preference share capital, debentures, term loan. So what is the total value of book value of equity here? Equity is 240 and reserves is 360. Both put together is the book value of equity. Always when you are calculating book value, if there is no, if suppose remember this, if there is separate cost for reserves and separate cost for equity share capital, then you should take this reserve separately in book value. If suppose book value they have not given any cost for reserves, that is cost of reserves, then you should add it to the equity share capital when you are calculating book value weights. So here equity is 240 plus 360, that is in respect of equity record 600, in respect of preference share capital record 120, in respect of debentures record 120, and term loan 360. Now totally 600 plus 120 plus 120 plus 360, you are getting 1200. In respect of BV column, put total 1200. Now calculate the weights. For equity 600 divided by 1200, you are getting 0.5. Equity 0.5, preference share capital 0.1, debentures 0.1, and term loan 0.3. Now weights calculate by dividing individual weights by total weight. You are getting 0.5, 0.1, 0.1, and 0.3. So KS, in respect of KS, take down all the different cost of sources of capital we have calculated. For equity, cost of equity is 16.36%, that is 16.36, and preference share capital is 9.17, and debentures is 6.29, term loan is 8.40. Term loan is 8.40, and product, in respect of product, multiply weights and KS. So in respect of equity, first for equity calculate 16.36 into 0.5. We are getting 8.18. Product column record 8.18. Then for preference share capital 9.17 into 0.1. 9.17 into 0.1. Record in the product column 0.917. 0.917. Next for debentures calculate 6.29 into 0.1%. 6.29 into 0.1%. Product column record 0.629. And for last term loan 8.4 into 0.3. 8.4 into 0.3. In product column record 2.52%. 2.52. Now product column total it 8.18 plus 0.917 plus 0.629 plus 2.52. You are getting total of 12.25%. 12.25%. In respect of the 12.25%, record KO. KO is equal to 12.25%. That is book value weights. Now calculate it for market value weights. Below that, put statement number 3. Statement number 3, market value. Market value. Same 5 columnar table. Record source, BV, weights, KS, and product. Source, BV, third column weight, fourth column KS, and last column product. Below that source, record equity. Equity. How much is the market value? We should calculate. See, X dividend equity share price is 15. That is market value price is 15. Total equity value is 240. So 240 divided by 10 into 15 is the market value of equity. When you are calculating market value, it forms part of reserves. See, you should remember this. When you are calculating book value, you should add both equity and reserve. And when you are calculating market value, equity and reserves put together is always shown as market value of equity. So here equity. Next to equity, open a bracket. 240 divided by 10 into 15. Because market value is 15, face value is 10. So 240 divided by 10 into 15. In respect of book value, record 360. In respect of book value, record 360. Then below that preference share capital, open a bracket. How much is the ex dividend price? 12. How much is the face value they have distributed? 10. So 120 divided by 10 into 12. So preference share capital, open a bracket. 120 divided by 10 into 12, close the bracket. 120 divided by 10 into 12, close the bracket. In respect of market value column, record 144. Sorry, I told book value, I think so. Here, source, next market value, weights, KS, and product. So it is market value. So preference share capital market value is 144. So below that, debentures. Debentures is, see, for every 100 rupees debentures, that is for every 100 you are getting 102.5. So 120 debentures, open a bracket, 120 divided by 100 into 102.5. That is the market value of debentures. So 100 divided by 120, 120 divided by 100 into 102.5. So in respect of market value column, record 123. 123. And term loan, there is no change in the market value of term loan, that is 360. Because term loan, it won't change. So term loan, market value 360. Now market value, total it. Market value column, total it. You are getting 987. You are getting 987. So total market value is 987. Using that, you can calculate what is weights. Now calculate what is the weight of equity. 360 divided by 987. You are getting 0.365. 360 divided by 987. You are getting 0.365. Next, preference share capital. 144 divided by 987. You are getting 0.146. In respect of preference share column, record weights 0.146. Debentures 123 divided by 987. 123 divided by 987. You are getting 0.125. And term loan 360 divided by 987. 360 divided by 987. You are getting 0.364. 0.364. So this is the weights. Now what is the different KS, cost of different sources? Just copy it from the first column. That is for equity it is 16.36. For equity 16.36. For preference 9.17. For debenture 6.29. And for term loan it is 8.40. 8.40. Now multiply both weights and KS, you are getting product. By multiplying both weights and KS, you will get product. So 16.36 into 0.365. That is 5.97. Equity is 5.97, product 5.97. And for preference, 9.17 into 0.146, you are getting 1.34. And for debentures, 6.29 into 1.125, you are getting 0.79. And for term loan, you are getting 8.4 into 0.364, you are getting 3.06. Now total it. Amount column, it is you are getting total amount, that is total cost of overall cost of capital is 11.16. In respect of this 11.16, record KO is equal to 11.16. As per market value, overall cost of capital is 11.16. With that, we have completed problem number 6. Now moving on to problem number 7. Here, this is a small concept. Problem number 7 is small concept of calculating what is the right issue, value of right issue. Small concept of calculating what is value of right issue. So first read the problem. BCM Limited makes a right issue at 5 rupees per share. BCM Limited makes a right issue at 5 rupees per share of 1 new share for every 4 shares held. Before the issue, there were 10 million shares outstanding. And the share price is rupees 6. See, with this, what you can understand, BCM Limited is trying to make a right issue at 5 rupees per share. That is, suppose if I am a shareholder of BCM Limited, if I have 4 shares in BCM Limited, then I can purchase 1 share by giving 5 rupees. If I have 4 shares, then I am eligible to purchase a right share of 1 right share, that is for 5 rupees. I can give 5 rupees and purchase a share. So before the issue, there were 10 million shares outstanding and share price was 6 rupees. So total shares outstanding is 10 million. So 10 million and share price was 6 rupees per share. Based on the above information, you are required to compute the total amount of new money raised. So 10 million shares, that is 1 crore shares divided by, that is 10 million divided by, for every 4 shares you are getting 1 share, that is 2.5 million shares you are issuing. So 2.5 into 5, that is 12.5 million is the new amount of money raised. That is what they are asking us to calculate in point A. Second, point number B, how many value of 1 right are required to buy 1 new share? That is, you need 4 shares to buy 1 new share. What is the value of 1 right? There is a separate formula for calculating value of 1 right. Using that, we can calculate what is the value of 1 right. And they are also asking us to calculate prospective X right price. So we have to calculate all 4 using this data what they have given. That is simple. A company is making right issue. They are issuing 1 share for every 4 shares at 5 rupees per share. And total outstanding shares are 10 million shares. And the outstanding price per share is 6 rupees per share. Using this, calculate all 4 things. So now come to the solution. Put the heading problem number 7. Statement number 1. That is calculation of amount received on right issue. What is that? Here they are asking total amount of new money raised. That is, by issuing right issue, how much is the new amount raised they are asking. So small problem number 1, calculation of amount received on right issue. How much is the right issue amount you are receiving? Below the 2 column net table, first column particular, second column amount. Below that particular record, capital small a, number of outstanding shares outstanding before right issue. In respect of amount column, record 10, because 10 million shares are outstanding. In respect of amount column, record 10. Below that small b, rights ratio. How much is the rights ratio? For every 4 shares, 1 share you are getting. That is 4:1. So rights ratio is equal to 4:1. Rights ratio in respect of amount column, record 4:1. Below that small c, number of right shares offered. That is, below that open a bracket, for 10 million shares outstanding, 10 divided by, for every 4 shares you are getting 1 share, divided by 4 into 1. Number of shares offered within bracket 10 divided by 4 into 1. In respect of amount column, record 2.5. That is the number of shares which is been issued as right shares, 2.5 million shares. Below that small d, Below that small d, issue price of right issue, right share. Issue price of right share. Or what price you are issuing right share? 5 rupees per share. So issue price of right share, small d, issue price of right share, amount column record 5. Now amount column total it. 2.5 into 5. You are getting 12.5. Below that small e, below that issue price of right share, record small e, amount received on issue of right share, amount received on issue of right share, within bracket C into D, within bracket C into D, in respect of amount column record, what is C? 2.5 into 5, that is 12.5. That is 12.5 million rupees has been received in respect of new right issue. That is what they have asked, amount of new money raised, that is 12.5 million. With that we have completed A. Now coming to B, how many value of one rights are required to buy one new share? You should have 4 shares in order to purchase one new share. So below that, take down small Roman number 2. Small Roman number 2. The shareholder should have 4 shares to get one right share from the company. To get one right share from the company. So that is the answer for problem point B. The shareholder should have 4 shares to get one right share from the company. To get one right share from the company. Next, see what is the value of one right. What is the value of one right? So we should calculate value of one right using a formula. So what is that formula? Actually, this is actually in the accounting standards. You'll get this in the accounting standards. This particular item. I think so. Accounting standards 20. No, not 20. I don't remember the exact number. So there you'll be doing this theoretical X issue price and value of per right share, value per right share. So both this you'll be calculating there. So the formula that you are going to use here. So what is this theoretical X issue price is? Market value before issue and market value like a market value of shares which is before issue plus what of the issue price issue value right issue of shares. If you add both and divide it by total market value, you will get what is theoretical X issue price. From the theoretical X issue price, if you deduct the right issue price, you will get value per right share. And from value per right share, if you deduct the total number of shares, that is 4 shares, you will get what is value per one right. So we'll just do the formula so that you will understand this. So put the heading small Roman number 3, calculation of value of one right. Calculation of value of one right. First theoretical X issue price is equal to, they are asking us value of one right. For that, first we need what is theoretical X issue price. So first theoretical X issue price is equal to, open a bracket, N1 into MP1. What is this N1? N1 is nothing but what is the shares before right issue, that is 10. N1 into MP1. What is the value of MP1? 6 plus N2 into MP2. What is N2? N2 is nothing but 2.5. That is 2.5 million shares you are issuing at 5 rupees per share. That is MP2. So N1 into MP1, close the bracket, plus N2 into MP2 divided by N1 plus N2. This below that is equal to, open a bracket, 10 into 6, close the bracket, plus open a bracket, 2.5 into 5, close the bracket, divided by 10 plus 25. Divided by 10 plus 25. Below that is equal to, what is 10 into 6? 60 plus 2.5 into 5, 12.5 divided by 10 plus 25. 10 plus 2.5, that is 12.5. So 60 is the value of market value of shares before right issue. So value of market value of shares for the right issue, that is 12.5. If you add both, that is 72.5 divided by what is the total number of shares that has been issued? 10 million outstanding shares plus 2.5 million outstanding shares, that is 12.5. If you divide both, you are getting 5.8. So 5.8 is the theoretical X issue price is equal to 5.8. That is theoretical X issue price. Simple. What is the market value before right issue? That market value plus what is the right issue market value divided by total shares, that is before market value plus right issue value. What is the total shares? If you divide it with that, you will get what is the theoretical X issue price. From the theoretical X issue price, if you deduct the right issue price value, you will get what is the value per right share. So below that, first arrow mark, second arrow mark, value per right share is equal to X issue price per share, minus right issue price, that is 5.8 minus 5, 5.8 minus 5 is equal to 0.8. Below that, so what is value per right share? Per right share is 0.8. For per right share, how many number of shares you should have? 4 shares. So if you divide the value per right share divided by 4 shares, you will get what is the value of one right. For holding one share, in the existing share capital, you are having right of 0.2. You are getting value of one right as 0.2. So value per right share is 0.8, and for that 0.8 you should hold at least 4 shares to get one share. So 0.8 divided by 4, that is 0.2 is the value of one right. So below that, record third arrow mark, value of one right is equal to 0.8 divided by 4, that is equal to 0.2. 0.8 divided by 4, that is equal to 0.2. Then next is, what is the prospective X right price? Prospective X right price is nothing but theoretical X issue price. So below that, small d record, just comment, it's like a comment. Below that, small d record, the prospective X right price per share. The prospective X right price per share is 5.8 rupees. Theoretical X issue price is nothing but prospective X right price per share. So 5.8 is the prospective X right price per share. Okay, done. With that, problem number 7 is over. Problem number 7 is over. Now moving on to problem number 8. Come to problem number 8. A Limited wishes to raise additional finance of 10 lakh for meeting its investment plans. It has 2,10,000 in the form of retained earnings available for investment purposes. See, the A Limited is planning to raise finance, that is 10 lakh rupees of the funds. How it is procuring 10 lakh funds? 2,10,000 from its retained earnings. So first 2,10,000 is from retained earnings. The following are the further details. Debt to equity mix is 30:70. That is 10 lakh they are procuring as 30:70. 30% is from debt and 70% is from equity. So out of that 10 lakh, 30% is from debt. So 3 lakhs is from debt. Below that, cost of debt up to 1,80,000 is 10%. So total 3 lakhs debt you are raising. Out of that 1,80,000 is 10% debentures. Remaining 1,20,000 is 16% debentures. Anything beyond 1,80,000 is 16% they are given. So total debt is 30%, that is 3 lakhs. Out of the 3 lakhs, 1,80,000 is 10% debentures. Remaining 1,20,000 is 16% debentures. Then earnings per share is 4 rupees. EPS is 4. Dividend payout ratio is 15% on earnings. Expected growth rate in dividend is 10%. Current market price per share is 44, and tax rate is 50%. So with all these data, you are required to determine the pattern for raising the additional finance. That is simple. 30:70. 3 lakh is debt, 70%, that is 7 lakh is equity. Out of the 7 lakh, 2,10,000 is reserves. Remaining 4,90,000 is issue of equity share capital. So that is the pattern of raising additional finance. To determine the post-tax average cost of additional debt, that is using the 16% and 10% both put together, what is the average cost of additional debt, that is after tax they are asking us to calculate. And C, to determine the cost of retained earnings and cost of equity, that is to determine the cost of equity. Then compute the overall weighted average tax of cost of additional finance. So simply for additional finance you are required to calculate what is the total weighted average cost of additional finance. So come to problem number 8. Come to the solution. Problem number 8. Put the heading. Statement number 1. Statement showing pattern of raising additional finance. Statement number 1. Statement showing pattern of raising additional finance. Raising additional finance. Below the 3 columnar table. First column particulars. Second column amount. Third column also amount. First column particulars. Second column amount. Third column also amount. Under particulars, see how they are segregating the additional finance. 30:70. 30% debt, 70% equity. Under particulars, small a, debt within bracket 10 lakhs into 30%. Within bracket 10 lakhs into 30%. Below that, first arrow mark 10% debt. How much is the 10% debt? 1,80,000, and remaining is 16% debt. First arrow mark 10% debt. Inner amount column record 1,80,000. Inner amount column record 1,80,000. Below that second arrow mark 16% debt. 16% debt within bracket 3 lakh minus 1,80,000, that is 1,20,000. So inner amount column record 1,20,000. Anything beyond 1,80,000 is 16% debt. So 1,20,000 is 16% debt. Now inner amount column total it record outer amount column 3 lakhs. Inner amount column total it record outer amount column 3 lakhs. That is debt part. Below that small b equity. Below that small b equity, underline it. Below that first arrow mark retained earnings. How much is the retained earnings? 2,10,000. So below that first arrow mark retained earnings. Inner amount column record 2,10,000. Inner amount column record 2,10,000. Below that second arrow mark equity share capital. Equity share capital. How much is the percentage of total equity? 70%. So open a bracket. Below that open a bracket. 10 lakh into 70%. 10 lakh into 70%. Close the bracket minus how much is the retained earnings? 2,10,000. So 10 lakh into 70% minus 2,10,000. You are getting 4,90,000. Inner amount column record 4,90,000. Inner amount column record 4,90,000. Now inner amount column total it. Record outer amount column 7 lakhs. 7 lakhs. So now outer amount column total it 7 lakhs plus 3 lakh, that is 10 lakhs. 7 lakhs plus 3 lakhs, that is 10 lakhs. In respect of the 10 lakhs, record small c total additional finance to be mobilized. Total additional finance to be mobilized. Now second, what they are asking to determine the average cost of additional debt. So 10% and 16% are the two different debts. So you should calculate average of that. So below that small Roman number 2, calculation of average tax, calculation of after tax average cost of additional debt. Calculation of after tax average cost of additional debt. Average cost of additional debt. Below that 5 columnar table. First column source, second column BV, third column weights, fourth column KD. KD is nothing but cost of debt, and fifth column product. What is that KD? KD is after tax KD. So below that sources record 10% debt. There are two debts, 10% debt, 16% debt. Record 10% debt. Below that 16% debt. How much is 10% debt book value? 1,80,000. In respect of 10% debt book value record 1,80,000. 16% debt record 1,20,000. 1,20,000. Now book value total it. 1,80,000 plus 1,20,000, you are getting 3 lakhs. Total it to 3 lakhs. Next weights. In respect of weights, how much is 1,80,000 divided by 3 lakh? 0.6. So in respect of 10% debt record 0.6. 1,80,000 divided by 3 lakhs. Then 16% debt 1,20,000 divided by 3 lakh, you are getting 0.4. 1,20,000 divided by 3 lakh, you are getting 0.4. Now weights total it 0.6 plus 0.4, you are getting 1. So next, what is after tax cost of debt? See, here they have given both before tax cost of debt, that is 10% and 16%. Here tax rate is 50%. So 10% into 1 minus tax rate, that is 1 minus 0.5 is 0.5. So 10 into 0.5, you are getting 5. So in respect of KD, first below that within bracket record, below that 10% debt within bracket record 10 into 10 open a bracket 1 minus 0.5. How much is the tax rate? 0.5. So 10 into 1 minus 0.5, you are getting 5. So in respect of 10% debt record 5. And in respect of 16% debt record 16 into within bracket record 16 into open a small bracket 1 minus 0.5, close the small bracket and close the bracket, you are getting 8. So in respect of 16% debt record 8. It is simply that after tax debt. Before tax debt is 10. Then 50% tax will go. Remaining 5 is the after tax debt. And 16%, 50% out of 16%, 15% tax will go. Remaining 8% is the after tax cost of debt. So 5 and 8. Now multiply weights and the cost of debt, you will get product. 0.6 into 5, you are getting 3. 0.6 into 5, 10% debt, you are getting 3. And for 16% debt, 0.4 into 8, you are getting 3.2. 8 into 0.4, you are getting 3.2. Now total the product. 3 plus 3.2, you are getting 6.2. 6.2. In respect of the 6.2 record KD. For knowledge, for understanding purpose, below that take down. Note 1. After tax cost of debt is equal to pre-tax cost of debt into 1 minus tax rate. Pre-tax cost of debt into 1 minus tax rate. That is enough. Note 1. After tax cost of debt only you should consider is equal to pre-tax cost of debt, that is 16% into 1 minus 0.5. You are getting 8. So just take down the formula on enough. After that, below that take down small c. What is the c they have asked? To determine the cost of retained earnings and cost of equity. Okay. Using the earnings per share and dividend payout ratio and expected growth rate, you can easily find out what is the cost of equity. Now calculate. Below that c, calculation of cost of equity and retained earnings. Calculation of cost of equity and retained earnings. What is the cost of the formula for suppose here they are given earnings per share and they are given dividend payout ratio. Using the dividend plus growth rate model, you can easily find what is the cost of equity. So below that KE is equal to D1 divided by NP into 100 within bracket D1 divided by NP into 100. D1 is dividend and NP is dividend. D1 means dividend including the growth rate. So dividend including growth rate divided by NP into 100 plus growth rate into 100 plus growth rate. So below that record, how much is the dividend including growth rate? Below that leave 3 lines gap record. Note 1. D1 is equal to D0 open a bracket into D0 into open a bracket 1 plus growth rate. 1 plus growth rate. What is the see? For calculating D1, we should calculate what is the D0 into 1 plus growth rate. Here, how much is the D0? D0 dividend payout is 50% of earnings. So earnings per share is 4. Out of that 50% is the dividend. So 4 into 50% you are getting 2. So DO is 2 is equal to below that record is equal to DO is equal to 2. Open a bracket 2 into open a bracket 1 plus how much is the growth rate? 10%, that is 0.1. So 1 plus 0.1 close the bracket. So 2 into 1.1 you are getting 2.2. So is equal to below that 2.2. D1 is equal to 2.2. D1 is equal to 2.2. So come to the formula above. D1 is 2.2 divided by net profits, that is current market price is nothing but MP is equal to NP. I have told you market price is nothing but net profits. So current market price is 44. 2.2 divided by 44 into 100. Close the bracket. Plus 10, that is growth rate, plus 10. So you are getting 15% is equal to 15%. 5 plus 10, that is 15%. So cost of equity is 15%. With that we have calculated what is cost of retained earnings and cost of equity, that is 15%. So below that what they are asking? They are asking weighted average cost of additional finance, that is cost of capital, overall cost of capital. Below that take down small d. Next statement, take down small d. Calculation of overall cost of capital of additional finance. Calculation of overall cost of capital of additional finance. Below that 5 columnar table. Record first column source, second column BV, third column weights, fourth column specific, that is specific KO. We can take it as KS. Fourth column KS. Last column product. Below that sources record equity debt. How much is the book value? In respect of equity record 7 lakhs and in respect of debt record 3 lakhs because it is 70:30. So 3 lakhs total 7 lakhs plus 3 lakhs you are getting 10 lakhs. BV column total 10 lakhs. So in respect of weights how much is 70:30? So 0.7, 0.3. In respect of equity record 0.7, in respect of debt record 0.3. So specific KO. In respect of the specific KO, record how much is the equity 15%. So 15%, 15, and how much is the debt? Debt you have calculated 6.2. 6.2. In respect of equity 15 and in respect of debt 6.2. So now multiply it. 15 into 0.7 you are getting, in respect of product column record 10.5. Weight into specific AO you will get product. So 15 into 0.7 you are getting 10.5. And in respect of debt column 6.2 into 0.3 you are getting 6.2 into 0.3 you are getting 1.86. 1.86. So now product column totally 10.5 plus 1.86 you are getting 12.36. You are getting 12.36. Total amount column record 12.36. In respect of that record KO. So it is nothing but 12.36 is the cost of capital of additional finance. So with that we have completed problem number 3. Problem number 3. So with that we have completed what is problem number 3. Now last problem, that is problem number 2, is left in this cost of capital. So it is very simple. If you do itself, you can easily complete this problem number 2. What are we have done in all the problems, that is summation of that is cost of this problem number 2. We should calculate cost of each capital. So okay, first these all 4 are different cases. Using that we should calculate what is cost of capital. Calculate the cost of capital from the following. Case number 1, 10-year 14% preference shares of 100, redeemable at a premium of 5%, floating cost is 5%, dividend tax is 10%. That's all. Here they have given redeemable preference. So redeemable cost of preference share we should calculate. So come to the problem. Put the heading problem number 2. Problem number 2, statement number 1. Cost of redeemable preference. Cost of redeemable preference share is equal to PD plus within bracket redemption value minus net process divided by N, RV minus NP divided by N, whole divided by RV plus NP divided by 2, RV plus NP divided by 2 into 100. So here what is the preference dividend? 14% preference on, that is 14% preference on 100 rupees per share. So 100 rupees per share into 14%, you are getting 14 rupees. Whereas dividend tax is 10% on that, which is to be paid by the company. So 14 into 10%, you are getting 1.4. So total dividend payout is 14 plus 1.4, you are getting 15.4. That is the cost of preference dividend which you are paying, 15.4. So in respect of that, leave 4 lines gap, record note 1. Leave 4 lines gap, record note 1. Calculation of preference dividend per share. Calculation of preference dividend per share. Below the 2 columnar table, first column particular, second column amount. First column particular, second column amount. Below that particulars record small a preference dividend per share. Small a preference dividend per share. How much is the preference dividend you are paying per share? 100 into 100 rupees per share into 14%. Amount column record 14. Amount column record 14. Below that small b add dividend tax at the rate of 10%, which is to be paid by the company. But see, right now, as per budget of 2020, that is the budget, union budget has been issued in 2020. Nirmala Sitharaman, she has told that the dividend distribution tax is totally abolished. That is, dividend should be paid by the receiver. The person who is receiving the dividend, he should pay the dividend tax on that as per his normal tax scheme. That is, whichever tax lot which he is falling, whether it is below 5 lakhs or about 10 lakhs, on that percentage you should pay tax on dividend. For companies, this dividend distribution tax, that is DDT, it has been removed. So this dividend tax 10% right now, as per the union budget, it should not be included. Whereas in this sum it is included, because the problem for this sum, that is, this 10% should be included in order to calculate the cost of preference. Okay, below that add dividend tax at the rate of 10%, that is 1.4, 14 into 10%, that is 1.4 in respect of amount column 1.4. Now total the amount column 14 plus 1.4, that is 15.4. 15.4 in respect of that 15.4 record small c dividend including tax. Dividend including tax, amount column record 15.4. Amount column record 15.4. So that is the total dividend. Below that note 2, redemption value is equal to redemption value is equal to, you are redeeming at 5% premium. So 100 into 105%. 100 into 105% is equal to 100 into 105% is equal to 105. Is equal to 105. Below that, working note number 3. Working note number 3. Net profits is equal to, here there is 5% flotation cost, which should be reduced from the total preference shares value. That is 100 minus flotation cost, you will get what is net profit. So note number 3, net profit is equal to 100 into, what is the net profit percentage? 100 minus 5% of floating, that is 95% is the net profit. So 100 into 95% is equal to 95. Is equal to 95. So redemption value is 105. Net profit is 95. Dividend payout, dividend is 15.4. Using this, you can easily find what is cost of preference. So below that, come to the formula. Solution record is equal to 15.4 plus 15.4 plus within bracket 105 minus 95 divided by 10, within bracket 105 minus 95 divided by 10 whole divided by 105 plus 95 divided by 2 whole divided by 105 plus 95 divided by 2 into 100 into 100. So if you calculate it, you will get 16.4% is equal to 16.4%. Take down one more step, then write this 16.4%. This in between one more step is there, that is 15.4 plus 1 divided by 100 into 100. 15.4 plus 1 divided by 100 into 100. Then put is equal to 16.4%. Then only you will get full marks. In this note, it has been directly written. That is 16.4. Go step by step. Okay, with that we have calculated what is cost of preference. So next is case number 2. An equity shares selling at 50, paying dividend 6 per share, which is expected to continue indefinitely. Then dividend is 6 divided by 50 into 100. That is the cost of equity. So case 2, statement number 2, KE is equal to D1 divided by NP into 100. D1 divided by NP into 100 is equal to, what is the dividend? 6. What is the NP? 50 into 100. So 6 divided by 50 into 100 is equal to 12%. Is equal to 12%. Then case 3, the above equity share, if dividend is expected to grow at rate of 5%, just for the above percentage you should add 5%. That's all. So below that, case 3, statement number 3 record, KE is equal to D1 divided by NP into 100 within bracket D1 divided by NP into 100 close the bracket plus G, that is growth, is equal to, how much is the D1 divided by NP into 100? We have calculated 12. So 12 plus growth rate is 5%. So 12 plus 5 is equal to 17%. 12 plus 5 is equal to 17%. That is case 3. And last case 4, an equity share of a company is selling at 120 per share. The earnings per share is rupees 20, of which 50% is paid in dividends. See, selling price per share is 120. Earnings per share is 20, out of which 50% is paid in dividends. The shareholders are expected of company to earn a constant after tax of 10% on its investment on retained earnings. So they are asking us to calculate what is growth rate. First you should calculate what is growth rate, then only you can calculate what is cost of equity. See, here cost of equity we should find, but here they didn't mention growth rate, but they have given what is return on investment on retained earnings, and what is retained earnings percentage? 50%. So 50 into 10%, that is 0.5. 50 into 10%, that is 5% is the growth rate. So first we'll go step by step. Come to the statement number 4. Statement number 4, put the heading cost of equity. Cost of equity. Take down the formula. KE is equal to, same formula. KE is equal to D1 divided by NP into 100 within bracket D1 divided by NP into 100 within bracket D1 divided by NP into 100 plus G. Here what is D1? 10. Below that is equal to D1 is 10. 10 divided by, what is the selling price? Net profits 120. 10 divided by 120 into 100 within bracket 10 divided by 120 into 100 close the bracket plus, what is G? G we should calculate. Below that leave 2 lines gap, record note 1. Dividend per share is equal to, how much is the EPS given here? Earnings per share is 20. Dividend payout ratio is 50. So 20 into 50% is the dividend. So 20 into 50% is equal to 10. So that is the dividend which is being distributed. So dividend per share is 10, which we have already calculated. 10 divided by 120. Below that, note number 2, growth rate is equal to retention ratio into return on investment. Retention ratio into return on investment is equal to 50 into 10%. 50 into 10%. So retention ratio is nothing but 1 minus dividend payout ratio. Here dividend payout ratio they have given 50%. Then what is retention ratio? 1 minus 50%, you will get 50% again. So retention ratio is 50%, and return on investment on retained earnings is 10%. They have given 10% on its investment on retained earnings. Whatever investment that has been retained, on the 10% return we are getting. So 50 into 10%, retention ratio is, growth rate is 5%. Retention ratio into return on investment percentage, that is 50 into 10%, you are getting 5%. That is the growth rate. So come to the formula. 10 divided by 120 into 100 within bracket, then plus 5. Below that is equal to 8.33 plus 5. 8.33 plus 5 is equal to 12.33%. Sorry, 13.33%. 13.33%. So with this, we have completed all the 8 problems in the cost of capital. So that is the cost of capital. You should always calculate what is the different. The only one problem which they will ask from this is, they will ask us to calculate all 3 cost of capital and use that in book value weights and market value weights and find the overall cost of capital. That is the only sum they will ask in this particular chapter. So with that, we have completed what is cost of capital. So with this, we have completed. Still 3 more chapters are left. We'll just finish off in few days. What like next? I don't think so. You are receiving videos regularly. Like it will be uploaded on time basis. So still 3 more chapters in financial management is left. Dividend policy, cost, capital budgeting, and capital structure. So all these three chapters are left. Okay. Thank you guys.